the trading, so it is on the basis of
No, give him the mic. Give him. I can't hear properly. The charts are long term.
So what actually you are saying is like Infosys is going up right now.
Yeah.
But this is what we are saying on the basis of a very long-term chart.
Okay.
Whereas our trading period is not even a month or 2 months.
Okay.
So I guess forming a view upon long-term view will not be a good perspective. Forming a view on a shorter view, like shorter time period, will be a better perspective.
Okay, I'll respond in two parts. One is that as a basic proposition, your statement is correct. That I'm teaching you how to approach the market based on long-term charts. Okay, but your trading project has a very short time horizon. Okay, so that's a fair point. But the second aspect of the response to that is that the long-term charts, the reason I was looking at the long-term charts is they give you the picture of the long-term trend. Okay, and even in your short-term trading horizon, okay, you are still because if the long-term trend is up, do you realize that even the short-term trends have more chances of going up than going down? Because that's how every long-term trend is also based on a series of short-term trends. Can you see that? That even this long-term trend, what is this? Basically, this is just adding up a bunch of short-term trends. Like a month is based on a number of days. Okay, so therefore, if a month is going to be very bullish, then, or if we're going to have very heavy rainfall in the month of July, then on every day in July there's a much higher chance of rain than there isn't than of no rain, right? So it goes both ways. You're partly right, so it is a little difficult, but in general you're still better off trading with the short-term trend. So even if you look at a shorter-term chart, okay, you will see most of the time like this jump which has happened, which is maybe outside your trading started from late July. Okay, but you can still see that this is overall an uptrend. Okay, so you will be biased towards buying, right? So therefore, so even there you can see that short term, eventually you'll see again that the short term trend also is likely to go up. You're likely to make money. You can obviously, because you're looking at a very short term trading project, which is like hardly 5 weeks or something. So therefore you have to look at very short term charts. But even then, if you remember what I showed you here, you don't have the luxury of these kinds of charts because we don't have the charting software for that. But in an ideal situation, when you're working professionally, these kinds of obstructions will not remain. Okay, so the approach would ideally be, if you're trading, once again, all of this is purely technical trading, okay, which is a valuable skill to learn. Okay, it's fairly simple, it's very rigorous, and it has the objective of being very objective, has the advantage of being very objective. Okay, so it's a useful skill to pick up. And ideally what you would do is you would approach it from this point of view. You would set up your chart system in such a way that you're looking at all the long-term charts. Okay, so like now, for instance, when I actually trade sterling, so I trade currencies right now. Okay, with real money. So what I've been doing is I had a good trade here where I was going short. Why was I going short? Because I was looking at the long-term trend and had a bearish view on the big picture, but then eventually I would end up using much smaller stops. But that gives you the bias. The big picture gives you the bias. Okay, so this is and this also is tied to the idea of trading in multiple time frames. Remember what we discussed the other day, that the idea of trading in multiple time frames. Okay, so for the sake of simplicity, we've only discussed 2 time frames, long term and short term. But you can actually trade in multiple. You can have multiple layers of trading systems. Each of them is a trading system, long term and short term. Okay, so you can actually have multiple layers of trading systems. Okay, which look at different time frames, right? So the second part of the response to your question is the long term is still important. Even in a short term trading project, the long term is important because the long term trend drives the bias in the short term trend. If that trend is not reversed, okay, like in the case of, like here also, if you're looking at cable, okay, if you're looking at cable, you can see the big picture trend is pointing down. Okay, there's a pretty strong downtrend. So even here, I would absolutely not think about buying this stuff at this point. Okay, I would only think of selling or not having or being square. Okay, because I can see the long-term trend. I see that the long-term trend bias is down. So in this case, I feel that the chances of making money are much better if you go short. So either you go short, okay, like I had a trailing stop over here from the earlier shot. So the trailing stop got stopped out last night. You can see the small thing here. So I had placed a trailing stop over here. The trailing stop is nothing but what we saw that day, what we did that day with TCS. You saw that we had placed a stop here. We put that, I'll explain this term later on, but it's a trailing stop, okay? That we had a stop here. Remember what we did? We split up the 1,000 shares position of TCS into two positions. One to be trading on the short-term trend where we had put the stop here, okay? And one to be trading on the long-term. This stop needs to be adjusted. For some reason, this level is not correct. When you look at these charts, they are actually showing you where your stops are visually. Many trading systems do that. Many trading systems which have also a charting application attached to it, okay, like here, one of the things they will do is, you can change this display format if you don't want to see all this stuff. You can change it in the chart settings, but by default what they're showing you is where your stops are when you're looking at this TCS chart, okay? So we'll come back to this, but basically what I was saying, so the important point to understand is that the even for short-term trading, the long-term trend is important because it gives you the bias, and you're better off trading in the direction of the larger trend. Okay, there you have more wind at your back. It's like flying into a tailwind. You know, like tailwind and headwind when you're taking flights. When the aircraft are flying, you heard this expression tailwind and headwind. Like, you never heard these expressions. When you're crossing the Atlantic in a particular direction, there's a tailwind or a headwind. A tailwind means they're hitting the aircraft in front, so it will slow you down. Okay, sorry, tailwind means it's coming from the back. Headwind is slowing you down. Okay, so it's the same kind of thing. So if you're trading in the direction of the long-term trend, okay, you actually have a tailwind, because the long-term trend is supporting you. So when you take short-term positions on the direction of the long-term trend, you have a better chance of success. Is this clear? Okay. So that's the answer to Tarun's question, hopefully. Now, we must correct this because we can see there was some problem, obviously. There was a mistake. There was a clerical error somewhere. So this stop should not be here. Remember that, guys? You remember this picture of TCS, what we were trying to do? Right? We had put one stop. We wanted one short-term stop. We want one stop for the short-term trend position and one stop for the long-term trend position. Is this clear? So we actually wanted, and you can see here from the highs, this is 8.5 and this is 8.1. This high is still 8.1. So it hasn't made a new high yet. Okay, so if it had made a new high, we would have shifted the big picture stop to this point. But because it hasn't made a new high, it has to be still here. Okay, all right, are you following? This is the same thing that we looked at. If you go back to this picture of TCS, yeah, it's the same thing that we looked at, remember? Okay, that we said that this, when we went long over here, we put the stop here. Okay, so half the position should have a stop over here, and half the position will be treated as a short-term position, and it has a stop over here right now. Okay, so we must correct this because we should actually see what the position, what the low is here. Are you guys following what I'm doing? Otherwise, please tell me. 2032, the low here, you can see the low. This is the low that we're interested in. So this low is 20. This is the daily chart. Okay, so this low is 2032.45, so we should put it at 2032.4. So this second stop that we have, it should not be 2165, it should actually be 2032.4. Are you following what I'm doing? I'm going to update it. Okay, and now you will see that yeah, now can you see that the picture is giving us, can you see that the chart is giving us, the stops have been adjusted on the chart also? Are you able to see visually now? No or no? Oh my God, okay, this is, okay, you can't see, but anyway, you can see something here at least? Okay. Can you see this? Yes. Okay. So essentially, in terms of that chart, what you have are basically this. Okay. You have okay. Essentially, on that chart, what is showing is one of the stops is over here. This low here. Can you see that? One of the stops is over here. This is the short-term position, okay, and one of the stops is over here. This is for the long-term position. Okay, is this clear? Now everybody's understood. Okay, so okay, yes, Garvit, what's your question?
Sir, I was asking, by doing this, it means that if we see that the lows are higher than the previous lows, this means that higher means higher. Actually, price they are not higher, so we should increase the.
What is not higher? You just said the lows are higher.
This means that the lows are not lower than that point. Means.
Okay. I think what you're trying to get
lows.
Yeah, I think what you're trying to get at is the reason I'm placing the stop over here is that if the market goes below this, it would have marked a lower low. Is that what you're saying?
Yes, sir.
Yeah. So that's why the stop is here. You understand the logic?
Yes.
So basic, simple definition. We started with the simple definition of the trend. Okay, simple definition, but it's a very powerful definition. It's simple, but it's not simplistic. You understand this word simplistic? You know what simplistic is? Simplistic is a negative what? You're smiling. Why are you smiling? Okay. So you have to frown in the class. You should never smile. Okay. Simplistic has a pejorative connotation. Okay. When we use the word simplistic, it has a negative connotation. So I say that the system designed by Piyush is very simplistic. That means it's not a good comment. It's a negative comment. Okay. Simplistic means it doesn't really capture all the essential elements that should be captured. It's too simple and it's not capturing all the elements of the system. But something that is simple need not always be simplistic. Okay. So you can actually have a system which is very simple, but at the same time is not simplistic. Okay. So what we are learning is difference between simple and simplistic. Okay, this is also something to learn because your communication skills are also important, and this kind of discussion may be important sometimes. Okay, something is simple but not simplistic. Okay, and it could also be simple and simplistic. Simplistic is a more subtle assessment, which means you're talking about the qualitative properties of the system. Okay, if something is simple, it's pretty obvious that something is simple. So you can have systems which are very simple and are still not simplistic because they capture the essence of the larger structure. Okay, so the idea, what I'm trying to tell you here is I'm using this kind of definition of a trend, the simple definition of a trend which we had: higher highs, higher lows. Remember? So it's a very simple definition. Do you agree? It's a very simple definition, but it's not a simplistic definition, because wherever you look in the world, even if you look at economic data, I've shown you some unemployment data charts.
Yes.
I've shown you some unemployment data charts. Even there you will see cyclical movement, higher highs, higher lows. When you look at, if you have good micro data on industrial production, GDP, okay, you have to plot GDP on a absolute basis, like $12 trillion, then goes down to 11 trillion, then 13 trillion, like that. If you plot everywhere you look in the world, you will see these kinds of patterns: higher highs, higher lows. You will see these cyclical patterns, you will see these uptrends and downtrends, and you will see that when you look deep inside those, you will see that there are always this pattern of this we call this a sawtooth pattern. Okay, that it's higher highs and higher lows. Okay, so this is like a sawtooth pattern. So this you'll see everywhere. So although the definition of the trend is simple, it's not simplistic because it captures the essence of the system and it captures it comprehensively. All trends will have this feature. All variables, whatever you look at, economic data, market, asset prices, everywhere you will have this feature. And therefore, it's always a logical. Can you see that the system is logical? That I am buying. Therefore, I'm maintaining a long position, or I'm buying additional shares. Okay, which means that I believe that the uptrend is going to continue higher. Okay, so the moment the market makes a new low, if it's going to continue higher, that means there should be a continuous pattern of higher highs and higher lows. Yes, all right. So the moment it goes and breaks the previous low and makes a new low, a lower low, then the pattern of higher highs, higher lows is broken. So which means my assumption about the uptrend continuing is destroyed. So if I do something based on an assumption and then we find that assumption is invalidated, I should reverse that action, and therefore logically I'm exiting those. You can see the system is logical also. It's not some arbitrary system. the sun is shining, so let me buy. So it's not an arbitrary system, it's a logical system, okay? So you can see how it's a very simple system and it's a logical system. And if you manage your risk properly, okay, if you allocate your position size with proper risk management, by doing this kind of trading, you will virtually never go bankrupt, okay? The market can never destroy you because you are in control. You are putting in your orders, you are sizing your positions correctly so that you don't lose too much on any particular trade, because you don't know what will happen on any particular trade, okay? So you have to be ready to lose money. So you budget, you size your position. We already saw that. You saw how position sizing is done by taking the risk into account.
Yes, sir.
Yes. So if you size your positions, you always put your orders into the market. Every position has a bracketed, at least has a stop order. Bracketing is not so important, but the stop is important. Okay, you can manage without brackets. Like I don't use take profit orders. I never use take profit. I only use this trailing stop. Okay, so that is still an okay system. But if you don't have the stops, then you're dead. Okay, you always have to have the stops. So, all right. So what were we saying here? Okay, so we're going to learn a new element of this, which is that the element of pyramiding. Okay, so you can see this now. Okay, pyramiding winners essentially means adding, or let's say let's call this increasing position size I'm not writing proper English, so I'm not writing the initial trade. When initial trade, because this is all broken English, this is just for our understanding. Increasing position size when initial trade has moved substantially into profit. Okay. All right. Okay. So let's look at how this is going to be done. Okay, so this is a very important thing to do. This is another element of technical trading that you're learning, very important element, because as a professional money manager, to produce outstanding returns, it is not sufficient that you just take the initial position, okay, and you keep a stock to protect your downside. Those are also important. But the other element that you have to add to it is the idea of pyramiding winners, which means essentially what is happening is, again, I'm looking at the big picture. Okay, I'm just looking at the big picture. You can't see anything here at all. Okay, let me try and see if I can change the colors. I'll have to edit chart. Let's see if I can change anything. It's just going to take a long time. Okay, we'll just do it with the. We won't wait for this. We'll just do it with this chart. Okay. So if you look at this here, okay, if we look at say 240. So 4-hour chart. All right. Okay. So as I said, now it's always important, even when you're trading in the very short term, with a very short term time horizon, you must have an understanding of the big picture. Okay. So when you're looking at this, you have. We'll continue with the TCS example because we've been working with it. So far, all you guys follow what has been done. Okay, that we saw this chart, it was falling here, and we decided to buy. We assumed that the uptrend would continue. So initially, we put a stop for the position here, 1,000 shares, and then it fell initially a little bit. Okay, it went out of the money a little bit, and then it has risen so far. So when we saw it rising, what we did is we split the position into two, 500 each. One we kept as a long-term position, and one we kept as a short-term position. And the short-term position was put here. We put a stop for the short-term position over here. Is everyone following? Okay, that's what we have done. Now, ideally, what would have happened earlier, because this 1,000 shares, I just bought it quickly because I wanted to do a trade to show you guys. So I hadn't thought about it properly. So ideally, what would happen is we would already be thinking about 2 time frames. So instead of buying 1,000 straight away, I mean, we would buy 1,000, but that would be conceived of as consisting of 500 for the long-term position and 500 for the short-term bucket, for the short-term position. So you put them in 2 different buckets from the very beginning. You may enter at the same time, okay, but from the very beginning. Okay, is this clear? All right. So what would happen now is, so what we are going to do with pyramiding. So what I was basically telling you is that, see, all trading is based on a big picture view. All trading should be based on a big picture view. So if you're a professional money manager managing an equity fund, okay, typically in this case, effectively it's a long only equity fund. So you're looking at this index is going down, but some of the stocks are doing well. So you look at TCS and you see that there is some, if you feel that there's a long-term upside potential on this stock, then you're trying to go and basically, see here you have to understand one more thing briefly, that I'll just give you before we go into pyramiding, this idea of diversification. You heard this idea of diversification? You heard the idea? All this Markowitz portfolio, why are two people going out at the same time? Tarun is already out. Who is this now just gone out? Tarun is already outside. So why has Gulati gone out? Call him in. Now you don't get stuck outside also. You call them and there's somebody else. Where's Adarsh? Adarsh has also disappeared. Why have so many people gone out together? Only one person, huh? Okay. But what about the other two? Where is Adarsh? Adarsh was here, no?
Yes.
He has disappeared. How did he disappear? Call him, no? Yash, call him. Tell him you don't have his number. Just call him. Who? Khushbu, you have his number? No, you are not allowed to call. But then he has to tell me, you can't just walk out of the class. If you're not feeling well, you have to tell me. Yeah, call him. Where is he? Okay. Alright. Okay, so Gulati is aware that he has to come back in case other people want to go out. Okay, you can't just go out and have fun. I see many people, even in classes are going on, I see people walking around outside in the corridor. It's like a party, it's a big party. Okay, have you guys heard of diversification? Okay, so while we are discussing the idea of pyramiding and how professional money managers take views on stocks, okay, how they manage this idea of stock picking, you've heard of this idea of stock picking? Okay. Okay, so basically most of the active management is going to be centered around stock picking, which means you have to start, everything in the index is not the same. You have to evaluate the stocks, you have to decide, okay, this stock is more likely to go up and this is not likely to go up, so I worry. So it's not like everything is equal and you have an equally balanced, diversified portfolio. Okay, that's not what active managers do. Most active fund managers will be engaged in stock picking, therefore selecting winners and losers. All right, so this idea of diversification, you've heard of this idea of diversification? Have you? Has everyone heard about diversification? Right? So this diversification is a very academic idea actually, okay? So most professional money managers, if you look at Warren Buffett, you look at, I forget what's the name of that guy, there was a famous money manager who managed money for George Soros, I'm forgetting his name, Jim Rogers, okay? Most of these guys, they laugh at this idea of diversification, okay? So if you look at Buffett's views on diversification, you can Google on YouTube, you can Google Jim Rogers. Jim Rogers is a very successful equity fund manager. All these guys laugh at diversification. So most professional money managers, this is a very academic idea, diversification, okay? Most professional money managers don't believe in diversification. They believe in concentrated bets, okay? So the opposite of diversification is so what I'm saying is Buffett, you know who Buffett is, right? If I just say Buffett, that is good enough. That is Warren Buffett. Jim Rogers, etc. frown on diversification. They frown on diversification because the point I'm trying to emphasize is you see the connection between these ideas. When we are talking about stock picking, okay, and we are saying that diversification is not that hot an idea in actual professional money management. Can you see the connection? That there are like 50 stocks in the Nifty. So if you wanted to be diversified, you would buy maybe 30, 35 stocks, etc. But if you are looking at stock picking and you think that diversification is not such a good idea, you're looking at concentrated bets. Most professional money managers who are very successful, they will typically have very concentrated bets. Okay, so are you following the idea of concentrated bets? You understand what is the difference between diversification? If you're diversified, then you have like 35, 40 stocks in your portfolio. But if you are concentrated bets, means you have only about 5 or 6 stocks in your portfolio. So you're making very concentrated bets on those stocks. Okay, so opposite of diversification is concentrated bets. The expression. Okay, you have to learn how to use the right lingo. Okay. So the idea is, the point I'm trying to make here is that diversification, you see in the textbooks, academic finance textbooks, you see diversification is a very big thing. But actually professional money managers, they laugh at these ideas of, you see Buffett videos on YouTube, he's laughing at diversification. Okay, this is for fools. You know, these kind of statements they make. Okay, opposite of diversification is making concentrated bets. I'm mentioning this here because it is connected to the idea of stock picking. That you are making bets on particular, you're evaluating different stocks in the particular universe that you're allowed to trade, which is the Nifty 50 stocks in this example, and you're saying that, okay, some of these stocks are likely to go up much more than the others. Okay, so what happened, others, you're not well. So if you're not well, you can go, but you have to inform me. You can't just walk out of the class.
I went for the medicine in my car.
Okay, okay,
So
fine.
got it.
If you want to go, you can
Yeah,
go.
fine.
Oh, you're okay. Okay. All right. Okay. So opposite of, you understand these terms. You have to always use the right lingo. As a finance student, you can't just talk like a layman. You have to use the right lingo. So the opposite of diversification is making concentrated bets. Okay. So essentially, what we are saying is we are connecting this to the idea of stock picking. So we are saying that here. So we are going to make concentrated bets. In this case, we find, let's say we find that the tech stocks are going up while the Nifty overall is falling. Let's say we find that, okay, maybe some other stocks are also going up. Then we are going to just go for concentrated bets on the tech stocks, okay, because our goal is to make money. We are not interested in just adhering to theoretical principles like diversification and all that, okay. We have to make money, and the way you make, those who make outstanding returns, they place concentrated bets, okay. So what you do is, you have to have a long-term view on these stocks, okay. There could be a fundamental element to that view as well. So you have a long-term view. Now, so you have this long-term view, and around this long-term view, you will do many trades, okay, all driven on this, driven by the same long-term view. Are you following what I'm saying? That you have a big picture view, and the big picture view doesn't change very dramatically overnight because it's a big picture view. So if you see this big trend, I don't want to give you a sense of complacency, lull you into a sense of complacency, but generally for this kind of a long-term trend to change, and it's a very long-term trend which you don't see even here, it's only a 4-hour chart, it will take a little time for it to change, okay. So you'll be able to detect it. So the point is that, so as this trend keeps on going higher and higher, okay, you can do many trades around that same trend, on that basic big picture view. Are you following what I'm saying? There are many opportunities to trade around the same big picture view, okay. So so what we are doing is, so therefore now we are splitting it into, and this is where the idea of pyramiding comes in, okay. So pyramiding, essentially we go back to the idea of pyramiding. Are you following what I'm saying? Are you guys following? Are you feeling like you're lost? Are you following the train of thought?
Yes.
Okay. So what we are saying is that pyramiding winners means essentially increasing position size when the initial trade has moved substantially into profit. Okay. This is an important point because you're going to increase your position size. So basically the idea is, it is similar again to poker strategy. We bring you back once again to poker strategy, and it's important to understand that, okay. Similarity to, you should also understand this, in our country we have a very, especially those who are very socially conservative will have, they think that all card games are all gambling. You know, oh my god, card games is gambling, okay. So there are certain card games which are games of skill, like blackjack and poker are regarded as games of skill. There's actually a US Supreme Court case also which has established that poker is to be treated as a game of skill, it's not gambling, okay. So one of the elements of poker strategy, as I told you, was that if you feel that your hand is not so strong, okay, relative to the others, then you should not bet, okay, you should fold. Then the other thing is, the flip side of that is, if you feel confident that your hand is very strong, then you should bet a large amount. Okay, are you following what I'm saying? So when your position is not, it's the same concept in cricket. If it's a good ball, then you should not try to, if it's outside the off stump, you shouldn't try to play a stroke, especially opening the innings. But if it's a short ball or it's a full toss, then you go for broke, right? Are you following? It's the same concept essentially. When you don't have the advantage, you try to be defensive, but when you feel the situation favors you, then you go for broke. Okay, so you have to be aggressive and you have to be defensive also, depending on the situation. Is this clear? So this is the idea of pyramiding. So similarity to poker strategy. Okay, we should actually say optimal poker strategy. Optimal poker strategy requires that when you have a strong hand, you should bet a large amount. Okay, so there is a very interesting book. I think that book deals with blackjack. But you can read that book if you want. There's a book by Ed Thorpe. Okay, it's called Beat the Dealer. This is again talking about, so this guy is a mathematician actually, and he's also a money manager. So he used to go around the Vegas casinos playing blackjack, but he was analyzing the cards and all that. So these guys are known as card counters. So the casinos don't like that. They want dumb people, you know, people who will just come in and just bet and without using their brains. They want dumb people. They don't want smart people who are actually counting the cards and doing probabilistic analysis in their head, because those guys will make money and then the casino will lose money. Okay, so what the casino wants is basically stupid people who just come and bet without thinking about things. Okay, so this guy used to go around the Vegas casino, and eventually none of the casinos would let him enter. Okay, so this is what happens with a lot of these card counters. Okay, so anyway, so this is an interesting book to read if you're interested in all these elements, blackjack and poker, and how you can think systematically about these things. Okay, and as I told you, many poker champions are actually being hired by hedge funds. Okay, so then this World Championship of Poker has a lot of prize money, actually quite a lot of prize money. So okay, so what were we saying? So pyramiding, when it essentially means increasing the position size when the initial trade has moved substantially into profit. Okay, so as you can see with respect to your big picture view, you know, I took this big picture view here. We had this view that okay, we could have had a bearish view also, but we decided to take a bullish view by assuming that the trend is still incomplete. So as it turns out, it seems to have moved substantially in our favor. Okay, which means what? It means that our big picture view about the uptrend still being intact is probably correct. Okay, so the market action is showing us that your big picture view is probably correct. So in this case now you have to really add to your positions and increase, because the more positions you have now, the more money you'll make. So you have to be really aggressive when the market is showing you that your initial big picture view is correct. So you have to pyramid your positions. So pyramiding here means think about what happens. Essentially, I'll tell you briefly what we are. Now we are going to zoom into this part again. Okay. Unfortunately, we don't have this kind of view which you have in sterling. Okay. We don't have that in. This particular system will not work for Indian equities. So we can't get this display here. But essentially, what we are going to do is the same thing. We are going to now zoom into this part. Is this clear? So I'm going to change it from 4 hours to 15 minutes. What am I doing? Am I increasing the granularity or decreasing? Increasing as in I. Okay, I'm increasing the granularity. And what is happening to the data range? Is it shrinking or increasing? Shrinking. Okay, good. Okay. So all these technical terms, remember, you have to, as a finance student, you have to be able to use these technical terms. Okay. So what I'm going to do as an idea behind pyramiding now is that, remember, we had two positions. So we have two positions. We have a short term, we have a long term position which is running with this stop, where the entry for both positions at the same time, around 2101 or something like that is our entry price. Okay, so both the long term and the short term position, the entry price is 2101, but the long term position is still running with a stop of around 2031, let's say, or 2032. This is clear to everyone? The short term position, what we have done is those 500 shares, we have now moved the stop to here. You remember that from the last class? Okay, is everyone clear? Okay, all right. So the way that we go back to our risk now, the idea behind pyramiding is that it's not sufficient that, okay, I did one trade here, I bought 500 shares for the long-term position, 500 for the short-term position, and then I have put my trailing stop for the short-term position, okay, here, and that's it. If it either it goes and stops me out here or it keeps on going higher, okay. That's not good enough. You have to pyramid. As a professional money manager, if you want to be really successful, when the trend is going in your favor, you have to be able to aggressively add to your positions. Okay, so how do you do that? What is the system? So the idea is now we are going to buy more. Basically, the idea is we're going to buy more, okay? And we're going to keep using this stop, the same stop, because we are going to buy, let's assume we are going to buy more for the short-term position right now, okay? We're going to buy more for the short-term position. Now you have to keep thinking in these two positions all the time, trading in multiple, and you can later on extend it to multiple time frames. You can have a very long-term system, a long-term system, a medium-term system, a short-term system, very short-term system. But for the sake of simplicity, I'm giving you only two systems. Is everyone clear? Okay, but you're not restricted to two. You can keep on increasing the time frame. So the idea is now we want to buy more, okay, and we are going to buy more for the short-term system, okay, so that we can make more money. This is clear? All right. In fact, actually, I think this will get stopped out, but never mind about that. Let's not assume that. Let's just assume that it's going to go up. I'm just going to show you the logic, how the logic of pyramiding works. Okay. So what did we do? So the question is, we want to buy more. So is this clear now? We're clearly established that we want to buy more for the short-term system. So we are pyramiding winners. Okay. So we are going to now practice this. Okay, so how does the pyramiding thing work? Okay, so in pyramiding winners, okay, we take the example of TCS. Okay, all right. So so we want to buy more for short term. If I write like this, is everyone okay?
Yes, sir.
We want to buy more for the short term system. Okay, this is clear. Using same. This is the shortcut for stop loss. Is this clear? Same stop loss. Actually, we should just call it stop. But anyway, as for earlier short-term lot. What is that earlier short-term lot that I'm referring to? This is when we bought these 1,000 shares. Actually, we were buying 500 for the long-term position and 500 for the short-term position. This is the earlier short-term lot that I'm referring to. Is this clear? You're going out where Gulati has not come back. What? Where is he? What is he? He's just hanging around outside. I frequently see him hanging around outside when the classes are going on. Just call him and. This is like, you know, when you see the babies, some of the babies, have you seen, when they start walking, they have a long leash like a horse. They have a leash on the baby walks for 10 feet and all, and then you can pull. We have to use that for all the students when they go out. You have to pull them back in. Okay, so we are going to buy more for the short-term system, clear? Yes. And we are going to use the same stop. Can you see once again the logic? Because if I'm buying for the short-term system, I'm saying that this degree of movement is my long-term trend, these big picture moves that you can see here. You can't see it here, but actually here there is a big picture movement, okay? These are the, I don't know why you still can't see anything. Anyway, so doesn't matter, but this is the big picture trade. This is clear to everyone? Okay, these are the long-term trends, okay? But the short-term trend is this degree of movement. Are you following? The short-term trend, if you don't follow at any time, when I look at many people, I see that their faces are all very looking blank. Okay, what is Aurora doing? Maybe we should come forward and you should hand over your phone also. Now you will also be a designated phone culprit. Now you will have to, where your phone is somewhere else. Okay, hand over, then come to the front. Now where will you come to the front? Who's sitting? Okay, that is Bharat is sitting there. Okay, you sit there, fine, no problem. Concentrate on what is being taught in the class. I don't want to see anybody looking down, looking here, looking there. Everybody should be looking at me. Okay, alright, yes, okay. What happened to Gulati? He's not coming, he's disappeared. Okay, but okay, so now who will call Gulati? Tell him to come back. Yes, you have. Okay, Mehak will call him. Okay. Okay, fine. Guys, now let's focus once again on this. Okay? Is this clear? So we are going to add, we are going to pyramid the position. You understand now what pyramiding is? Pyramiding means you're adding to your positions when the trend is going in your favor. Okay? So in the we are going to add the short-term position. Oh. Okay, we are stuck then. We are stuck. We can't do anything. So I'll have to penalize him. I'll just mark him absent for this class then, in that case, if he doesn't come back within a reasonable period. Okay, all right. So guys, now so we are going to add pyramiding. How are we going to do it? You could do it against a long-term system also, and you could also do it against a short-term system. But you'll see shortly why we are not doing it for the long-term system, because the long-term system is still going to lose money. Can you see that? If our whole view is proved to be wrong and the market just crashes down from here, goes through this top and then goes through this top also, then on the long-term position we are going to make money. Are we going to make money or lose money? We're going to lose money because we are long over here, 2101, and the stop is over here. Is everyone following? So we're going to lose money on the long-term position. So we are not in a position to add to the long-term position because the initial risk is still there. Okay, but look at the difference in the case of the short-term position. What has happened? The entry price is here and the stop is here. So if the stop is triggered, are we going to lose money or make money? What? Many people are looking blank. Yes, Kanika? Is my question clear? Clear. Question is clear. Yeah. So with respect to the short-term position, because our entry price is here for 500 shares and our stop is over here. All right. So if the stop is triggered, are we going to lose money or make money? We are going to make money. Okay. So in this case, that's why I'm saying that we can afford to add, because we are always willing to take some calculated risk. We already have a risk budget. It's not that we are always, like Tanya was saying, she doesn't want to lose money, but you have to be aggressive with your with a controlled risk approach. Okay. So you have to be always taking risk in a controlled way. What happened? Okay, so when you guys go, you have to inform me. You can't just walk out here, because you're supposed to, only one guy is supposed to go out at a time. So if you go out, then others can't go out. Okay, so you have to be responsible and come back on time. And if you're not feeling well or something like that, then you have to inform me. Then I can let you go. If I feel it's a genuine case, then I'll just let you go and you won't lose your attendance. Okay, but that doesn't mean everybody should start feeling unwell suddenly, right? Then we have a problem. Okay, all right. Okay, so is everyone clear about this? Why I'm talking about adding to the short-term position? Because the long-term position, the initial risk is still there, it's still exposed. Are you following? Because I took some initial risk for 500 shares between 2101 and this 2032, wherever our stop is actually. You can see this. Our stop is 2032. Okay, so this 2101 to 2032, this money we are still going to lose, because so therefore we can't afford to add to the long-term position, but the short-term position will make money if the stop is going to be triggered, so we can afford to add to it. Is this clear? So we're going to be pyramiding, because pyramiding is an essential part of your trading approach. Okay, a good trading system should have a pyramiding formula as well. Okay, so we're going to be pyramiding with the short-term system. All right, so now we come back to how much. So is this clear so far to everybody? So now what is the problem that we have? If we go back to our decision problems, okay, we have all kinds of decision problems: asset class, market, instrument. Have these already been solved in this case? Okay, asset class is what? Equity. Okay, market is TCS. The market is TCS. Is this clear? All right. And instrument is spot. Instrument is spot. Okay, everyone is clear? Should I bring up that framework once again? Okay, that's why you see your concepts have to be clear. Okay, your concepts have to be clear. Asset classes, markets, and instrument. The instrument is spot, because these are spot based. You're trading equities on a spot basis. You're not trading futures, you're not trading forwards, you're not trading options. Okay, so it is spot. Okay, and the asset class obviously is equities. Okay, so the market, some people had a confusion, but there should not have been any confusion, because I've explained this many times. In the case of foreign exchange, I told you that if I look at foreign exchange, how many markets are there? Essentially, there's NC2 markets where N is equal to, let's say, 170. Maybe there are 170 countries in the world. Okay, so every country has a currency. So theoretically, you have NC2 markets where N is equal to 169 or 170. This is clear. So every pair is a market. So similarly here, what you're trading is TCS is the base asset, and what is the terms asset? INR, correct? So you're actually trading, if you want to say it crudely, like when you want to talk to a computer, you say TCS INR. In this case, the market is TCS INR, okay? Or in layman's terms, when you're talking to a human being, you would say the market is, TCS common stock priced in INR, okay? Priced in terms of INR, that's why INR is the terms asset. Is everyone clear now? Okay, so we had a good revision on that. That was also necessary. Asset class market instrument is clear. Buy, sell. Now we are talking in particular about the pyramiding decision. Have we already made the buy sell decision? Yes, because we are already biased to the long side. We see that the big trend up seems to be going up. Okay, so we want to buy more. So the buy sell decision has also been made. Okay, and then this part we can actually just the other decision problem is entry price. Okay, entry price is whether. Basically, the entry price decision is whether we should use a market order, limit order, or stop order. Okay, this is the broad entry price decision, which means it's just basically a shorthand way of saying, I've written it as MO, LO, SO, okay, which is a shorthand way of saying, once again, this is almost like written for a computer, but if you're talking to a human being, the way you would explain it is, what is this entry price decision problem? Even after we have decided to buy or sell, there remains the question of at what price should we buy or sell? Should we just buy at the current market price? Should we just buy at the current market price, or do we think that we can get a more favorable price than the current market price? Or do we think that we want to buy at a less favorable price? That I have not discussed that option with you, but you should be aware theoretically that that option exists also. All right. So is everyone clear about what the entry price decision problem is?
Yes, sir.
You realize that this is a decision problem? Everybody understands what a decision problem is? Yes? Okay. So therefore now, so the entry price decision problem is MO, LO, or SO, whether I should use a market order, limit order, or stop order, okay, which is another way of saying whether I should buy at the price equal to the current market price, or at a price more favorable than the current market, or at a price less favorable than the current market. This last part, less favorable, we have not discussed it with you, and I'll explain it later, but it is an option as well. This is clear. This is what the entry price decision problem is. Now, for the sake of simplicity, at the moment we are just assuming that everything is, in every situation, this particular decision problem is solved by choosing a market order. Is everyone clear about this? This is our shorthand fudge solution for now. Okay. Later on, we'll deal with this problem in a little more depth. But for the moment, we can just save ourselves the time and the headache by solving this in the same way in every situation. Whenever the entry price problem, decision problem comes up, we are going to solve it by deciding to use a market order. Is everyone clear? Kulbu is not very happy with it, but you're clear about what we are saying, okay? Because I'm just trying to avoid having to discuss this problem in detail at this point. So I'm just applying a shorthand rough solution. Every case we just use a market order. Is this clear? Pulkit is also not very happy with it. You're happy? Okay. So I understand, obviously sometimes you can make more money if you use a limit order, okay, and it gets filled, okay, but sometimes the limit order, there are all kinds of pros and cons, we'll see that later, but for the sake of simplicity we just assume that everything is a market order. And as I told you, in the long term, if you see long-term system performance based on empirical data that we have on system testing, if you use this simplifying assumption and you're constantly monitoring the market, it's not possible humanly to constantly monitor, but if you have a trading system, it can, if you have an algorithmic trading system, it can actually monitor for you. But what I'm telling you is, as you can take this as a golden rule, that even if you use this simplistic solution for a very simple solution, again it's not simplistic, it's a simple solution for the entry price problem, even if you use this, it's not going to have an adverse effect long term on your trading system. Okay, because if you look at the research actually says that the real big decision is this one, okay? This is where the real big decision is. This is what affects, if you look at the research later on, okay? on trading system. The profitability of the trading system is really determined by the exit price. Okay, both the exit price, both with loss and with profit. This is really what determines the profitability of trading systems if you look at the research. Okay, so it's counterintuitive. Okay, most of the time, and what does theoretical finance focus on according to you? Which decision problem does theoretical finance focus on most of the time? Are you following my question? The finance theory that most of you guys have learned so far, and you look at your finance textbooks, you see what is discussed, and what the market also discusses when you look at your CNBC or you look at your Bloomberg TV, and you see all these analysts talking about things, talking about markets, right, and stocks or currencies or whatever. What do you think, which decision problem do you think that the general public and finance theorists focus most of their time on?
What are the three stocks?
Which of these? Asset class, market instrument, buy, sell, entry price, exit price. Where do you think the market?
Exit price.
Tarun is correct. Okay, so it's actually the buy sell decision. If you think about it, most of the heartache in the markets, you know, should I buy, should I sell, you know, do you think this is going to go up? If you think about it actually, and you look at your finance theory also, most of the all the fundamental analysis that you look at, okay, all the fundamental analysis, value investing, all these books which you should read, okay, I'll give you guys a list of books which you should read, okay, all of that stuff, all the heartache is focused on this one, which is not actually the right thing to do. Okay, let me therefore make it here, and this is what you should really be focusing on. We'll do it both ways. If I color it like this, can you still see it? You can see the colors. Okay, so what I'm telling you is actually, now this is all very hard-nosed, this is very unconventional stuff that I'm telling you. Okay, if you go and tell a finance professor, an academic finance professor, they would not agree with you. Okay, but I'm telling you this from the point of view of actual trading system performance in real money, in real money situations, in markets. Okay, all right, so you notice, so you should also be clear about this. Okay, so only Tarun or maybe somebody else also had it, but you should have understood that all this stuff, all this NPV, your IRR, NPV, all this stuff that you have done, all this company analysis, which you do, stock valuation, okay, you have to be able to see the connection, because ultimately most of the time what happens is when finance is being taught at most of the business schools, they just teach you this stuff, they don't really connect it to the decision problem. Okay, so what we are doing here is that entire curriculum is based on decision problems, because what really matters in life is decision problems. You have to solve these decision problems. If it's not connected to a decision problem, then we don't need to waste time on it. Okay, so so this is the point here, basically, right? So understand that all your theoretical finance, most of the markets agonizing and the heartache is all over the buy-sell decision. Okay, but actually what really matters is the exit price, and that's why I'm telling you that even in real life, if you design a system which always trades on market orders, it's not going to be a problem. It's not going to affect your system profitability. Okay, what is really going to affect it is the exit price, and then we'll see how much you lose on each trade, how much you try to make on each trade. I've already given you a preview of this trade-off. Okay, I've already told you that if you're risking say $1, if you're risking $1 on your entry when you enter the position, if your risk is $1, you should not take, and if it moves into a profit, you should be looking to make at least 3, preferably 4, 5, 6 times your risk. Are you following? Which means you're risking $1, you should look to make $3, $4, $6 on each trade in terms of profit. Okay, so we'll see how that works out. We'll see a mathematical formulation of that later on. Okay, so is everything clear about this now? So now when once again we are in the pyramiding problem. Okay, so when we go through the decision problems with respect to the pyramiding problem, we see that all these have already been solved. Asset class, market instrument has been solved. Buy sell is also solved, because pyramiding here, because our original positions are long and we are pyramiding, so that means we want to buy more. That is also clear. Now entry price I have forcibly solved for you by assuming everything is a market. Okay, all right. So now we have to worry about the important exit price decision, which is with a loss. Okay, if you have a loss, where will you exit? Okay, exit price with loss and profit, you understand? When it's moving into a loss, at what point do you cut your losses and exit? and when it's going into a profit, at what point do you capture your, realize your profits, okay, and do a take profit, okay. So this one, obviously the one with the loss is much more important, okay. As you can see, some trading systems, like I don't use it, my trading system does not have any profit orders, so I don't even have this decision problem. I have removed this decision problem. I only use that I have removed one decision problem, so I've made the system less complex to that extent, okay. So you can easily operate without a take profit. You don't need a take profit, okay. So we'll see how that is done, okay. But so this exit price, for first concern is exit price with loss. Is that also clear to us from our previous analysis? Yes or no? Yes, Aurora? Is my question clear? The exit price with loss, that based on the previous analysis we have done so far on TCS, and we are adding to our short-term, we are talking about pyramiding for our short-term position, okay, or our short-term system, okay. So in that context, in that particular context, has this decision already been solved, or do we need to solve it? The exit price with loss. Is my question clear? In the context of this particular example that we are discussing, okay, it's already solved, okay. Yeah, we already know it, right? This is the position somewhere around 2205. We can just look at the system. It is actually 2205, okay, which means the low must have been 2205.05, okay. So that's why the stop is at 2205. This is clear, okay. So we already know this exit, okay. So this exit at loss, this decision is already made, okay. And exit at profit, as I said, exit with profit is not so important. We can work even without this problem. So again, I'm going to minimize this problem for the moment and forget about it. Yeah. Yes. Yes, Gil, you have a question. Yes. Give her the mic. Give her the mic.
Sir, is pyramiding concerned only with the long position, or is it
no, both. If you see my definition, look at my definition. Increasing position size, okay, when initial trade has moved substantially into profit. This kind of language, does it encompass both long and short positions? Is it biased in any way? Right? Okay, so I'm not like, it's not like I'm saying he or she, I'm saying person. Okay, so here I'm saying increasing an initial trade has moved, so this could happen to short positions also. The same logic will apply. Okay, it's a fair question, but short answer is it applies both ways. Huh? Yeah. No, in this case, there's no vice versa. I don't need vice versa here in this kind of language. I say any person can come in. That means I don't have to separately say girls can come in, boys can also come in. So here this language is neutral with respect to the direction of the position, right? It is not talking about this part of the language, increasing position size when initial trade has moved substantially into profit. This language covers short positions also and long positions also. Do you see that?
Yes, sir.
Yes, Tarun? You're okay now? You still have some issues?
He was saying something else. He's saying that if you increase, when the position size decrease, it means that the initial trade has moved into loss.
No. It doesn't apply symmetrically. There's no vice versa on this. See, when you take initial position, increasing position size, let me make it more clear. From the initial, make it absolutely clear, from the initial position size, okay? Okay, even make it even more clear. Increasing total position size from the initial, okay, let's say initial position size, or we can put initial, we can put total here also. Is this clear?
Sir, what I am asking is whether this is in the case of profit that we are increasing. Some people try to, like when they are going into losses, they think that they are going into losses, it's better to buy at that particular loss, because when it will go up, it will cover both the profit.
Okay, what you're talking about, what Tarun is talking about is a different thing, which is called, we use a language like doubling down, okay? Doubling down, we can say, is, see the battery here has run out, okay. Doubling down is, I'm just going to use You don't have to write proper English. Opposite of, okay. Opposite, what Tarun is hinting at is opposite of doubling down on losers, okay? Or doubling down, okay, or averaging losers. Is it right? So what Tarun is talking about is averaging losers, or sometimes also called doubling down, okay? These are the expressions that we use in the market, okay? This is just the exact opposite of pyramiding winners. Pyramiding is the expression would be used for only winning positions, okay? So the idea is the position, the trend, the big trend is, your suspicion about the big trend was correct. So maximize, you know, your view, okay? Maximize your profits based on the correct view. This is actually, this is, again, as we say, we make that in the game shows, we have this "can" sound, right? Not to be done. This is a no-no. Okay. Pyramiding winners is a yes, yes. So we are teaching you the principles of good trading, which means pre-plan your risk, size your positions according to the pre-planned risk. It doesn't just fall from the sky. How many units to buy, it's not something that falls as an exogenous variable from the sky. Okay, it is an endogenous variable. Okay, this is to be done. This is clear? Pyramiding winners is okay, doubling down or averaging losers is not okay. Okay, so what Tarun is talking about, if we go back to his doubling down idea, what he's saying, you can see, as I was suspecting, this loss has been triggered. As you can see, our loss almost triggered, not yet triggered. It looks like on the chart, okay, almost looks like it's gone. Okay, all right, what time is it? Okay, it's almost 3. Okay, so what we're going to do is, right, what Tarun is talking about is, he's saying, what he's talking about doubling down or averaging losers. What he's saying is, okay, we bought 1,000 shares at 2101, okay, we bought it here, then we put a stop over here, okay. So typically the problem is that typically those who average losers, okay, they don't even have the plan of putting stops. So what they do is they buy here, okay, then as the market drops, okay, if I bought it here, then the market dropped, if you saw, for a few days it dropped. So if it drops here, if I'm averaging losers, means then I buy more shares here. Okay, so this is a very bad trading strategy. This is what amateurs do. Okay, so this you should not do. So so therefore you can also see that the concept of pyramiding doesn't apply in reverse. It applies to long and short positions, but when they are in profit. But it does not apply to, so when, let's say we bought 1,000 shares, let's forget about temporarily, or let's talk about only the long-term position, okay? So the long-term position, or let's talk about the full 1,000 shares, let's talk about, because both long-term and short-term would have been stopped out, okay? So you buy 1,000 shares, okay, and you put a stop over here initially, okay? Initially you put a stop over here. So when it starts going down, you don't increase your position. You've already planned that the loss will be from here to here, 2101 to 2032. This much money you're going to lose, and you're willing to lose that much money on 1,000 shares, okay, and whatever that loss is, that is okay with you. That's 1% of your risk capital. So that's why you enter 1,000 shares, entry price here, exit price here. Now if the position is moving into a loss, there's nothing more for you to do. Your management of the position, that burden increases only when you have a profitable position. Then you have to think about pyramiding. But when you have a losing position, there's not much additional work for you to do, because you've already planned everything. Okay, you planned 1,000 shares, this is the entry price, this is the exit price. You know what the maximum loss is. The maximum loss is equal to 1% of your risk capital. So you enter this trade, and then if it's going against you, there's nothing more for you to do. You can just forget about this position. Okay. But if it moves into a profit, then you have a lot more work to do, because you have to try and pyramid it carefully. Okay, this is clear? Okay, so that what you're talking about is doubling down. That's highly unprofessional. Okay, that means you don't have a risk plan. You just bought some, then you're losing money, and then you're saying, oh, it's even cheaper, let me buy some more. So eventually, you know what will happen is, eventually if it keeps on falling, okay, then you can have a huge loss. So and also it means that you're out of control. The moment you haven't put a stop into the market, when you enter a position and you don't have a stop in the market, means you're out of control. Okay, so in this kind of an environment, the market is merciless. So if you give up control, you will be taken out in no time at all. Okay, is this clear to everyone? Okay. we still have a lot of time. Okay, so we are going to just ignore this this movement. Okay, it's in fact because I just want to show you the principle, what is involved in pyramiding. There's another principle that you can use in your own trading. Okay, that is, so for pyramiding we've solved all the decision problems. You can see that stop is triggered. Can you see that? Only one is left. That stop has already been triggered. Okay, that's why I was telling you that in fact that I think it will get triggered. But so it got triggered, but we are just going to imagine that it has not been triggered, because I just want to show you how the principle works. Okay, all right. So what will happen is you had a stop over here, trailing stop. Okay, for your this is called a trailing stop. Okay, when you have let me just write this here in your thing. Okay, so the trailing stop concept is, a stop order. Okay, this is in your outline notes. Okay, so this trailing stops which you have access to. So trailing stop is a stop order. Okay, you know, every stop order has a trigger price. Okay, price shorthand is PX. Okay, trigger price for which has been adjusted higher, lower. Okay, after so it's a long definition, okay, which is going to be in your notes anyway. Okay, but this is just for your own reference. Visually, just understand it. What do we mean by a trailing stop? A trailing stop is nothing but where we talk about, okay, I enter two positions here at 2101. Okay, I enter a short-term position and a long-term position, 500 shares each. So now let's just talk about the short-term position to understand the concept of trailing stop. Okay, what it is when I enter the short-term position, even for that short-term position, the trailing the stop was here. Remember that? Initially, the stop for both positions was here. Is that clear?
Yes.
Okay, both were here. But when I saw this kind of movement and we saw this short-term trend developing, we moved the stop for the short-term position, we moved it higher than the initial stop position,
Yes.
because the market has moved higher. Okay, so we move it higher than the initial trade stop position and we moved it to here. Okay, so this is called a trailing stop. It's called trailing because, okay, so if one runner is running ahead and another running is behind, the second runner we say is trailing the first runner because he's behind. Okay, so the trailing stop, because the stop orders are always behind the market, because they are always going to execute at a price worse than the market. So even if it's a downtrend, like if the market is here and I put a stop order here, that is still behind the market. If the market is here and I put a stop order here, it's still behind the market because it's kind of trailing the market. Are you following? Okay, so it's less favorable. So that's all the trailing stop is. Trailing stop only means that initially you put on a position. Okay, initially you put on a position with a original stop level, but then in this case it's a long position. That's why I've given the definition as higher, lower, both sides. So it's a long position. So in this case, when the market moves higher, the market has moved higher after you did your trade. The market moved higher after you did your trade, which is what this is over here. The market moved higher, so you moved your stop also a little higher, according to a short-term pattern that you could see. Is this clear? That's why this was called a trailing stop. That's all a trailing stop means. That means it's trailing the market as it is moving. After you put on your position, the market moves in a particular way, and if it moves into profit for you, whether it's a short or long, okay, then you, instead of taking profit, you just use a trailing stop. Can you see here also when the stop got triggered, we made some money out of it. because we went long over here and we got stopped over here. Okay, so there's a profit involved into this. Okay, but it is still based on a stop order. That's why it's called a trailing stop, because it's trailing the market and as the market moves. Is this clear? Okay, all right. We still have 3 minutes. So the only thing that's left to do for us is, all the decisions have been taken. Only one decision remains, which is the number of units. That would be decided in exactly the same way. What we would do is, we would basically see, let's assume that since we had, okay, we can do it very quickly. Okay, how many, we can look at this later. Okay, so we had 500 shares for the short-term position, okay, and what was our entry price? 2101, let's say. Are you following? Can you read all that stuff?
Yes, sir.
Okay, Sukriti, you can read. Okay. So the question I'm trying to answer right now, I might take 2 minutes, okay, extra. I'll just give you the final, how to solve the final. So the question is, you're going to pyramid, then how many shares are you going to buy? Not necessarily 500 just because you bought 500 earlier. That has to be separately decided. How many are you going to pyramid with? Okay. So, how much did I put initially as a risk on the short-term position? 2101 minus, what is that other figure? 2205?
Yes.
Our long-term stop. Okay. So I was going to lose this much per share, and then I had 500 shares. Okay. What is this? Oh, I didn't put the into sign. Alright. So I was losing 52,000 per share. Okay. So therefore now what I have to do is, I have to figure out now where am I entering? How many? Okay, so if I'm entering, let's say I was not going to enter here because already below. Let's say I was entering at 2218 and the stop was 2210. Are you following? Don't get restless, just follow this. Let's say I'm planning to pyramid at 2218, that's where the market is. So I'm going to enter at 2218. 2218 and the stop is 2210. Okay. So I will therefore figure out how much am I losing. 8 rupees, okay, per share. I'm losing 8 rupees per share, and I can afford to lose 52,000. That was my initial risk bet for my short-term position. So therefore what I will do is, I will just write, I have to write ABS here. And divide by 8. Is this clear? ABS is, I didn't want this minus sign here. I didn't want a minus sign in the output. Okay, so I took ABS of 52,000. It's a minus. Is everyone clear what I've done? Barul is not clear. So you have to replay the video and understand it. All we are trying to figure out is, we said we have to pyramid, we want to pyramid, which we want to buy more. Everything is solved. Only thing that was left is the actual position size. How many shares to pyramid with? As you can see, the number is quite different now. Okay, so you can buy 6,500 shares because you're losing only 8 rupees per share. Okay, and you can afford to lose 52,000. This, we are assuming this 52,000 should have been the 1% of your risk capital for the short-term system. Are you following the logic? Yes, why 52,000? Why did you risk 52,000 initially for those 500 shares? That was the 1% risk capital allowed, 1% of your risk capital for the short-term system. Every system will have a separate allocation of risk capital. Are you following? So that's how you decide. Now you know how to pyramid. Yes, Yash is also not convinced, but we'll figure out somehow later on. Yes.
Sir, is it necessary to go for this 6,500
this is the maximum position size. This is the maximum.
You can go in parts as well.
Yeah, you can also go in parts. You can split. I'm just giving you the maximum position size. Is this clear? Is everyone following what has been done? So now you've learned something new. Further nuances to technical trading, how you can pyramid your positions when they are going in your favor. This is clear? Okay, fine. Your class is dismissed. So I've taken 2 minutes, yes? Tomorrow is 9:30 class, and then your next class is going to be, just check that timetable. Your next class is on 27th, I think. Next IPM class. Tomorrow we have 9 PM and 9:30.
Yes.
Is everyone clear? Tomorrow we have IPM at 9:30. So please convey a message to Vaishali that she has to meet Charendra sir. Okay. Anybody has any technical questions? Then I won't close the video. But 3 o'clock, nobody will have technical. Which other way around? Use the mic because there's too much noise. Use the mic so that we can capture anything. We are not going to close the recording. Yes.
Suppose I enter at this point at market price of 202 with 100 share PCS, and I know that this much.
You're talking about. Are you talking about a situation when even after the stop has been triggered or before?
A fresh trade.
That is, you have the information that this stop has been triggered. After that, you're doing it after that.
Fresh trade for me.
Fresh trade. I'm talking about, are you incorporating? Because for the purposes of our pyramiding example, I ignored this market action because I wanted to just show you how it's done. I didn't want to have to change the
I
stop.
have opened the chart of pieces to do, and I
So
see
now you're seeing this break, it's falling.
Yes.
You're seeing this break, it's
Yes.
broken this, okay? So you have the information that this short-term trend that has started, at least one phase of it has been neutralized, okay? Now only two things can happen in the big picture. Either it's eventually stays below this also and eventually breaks this also and this also, or it just maybe comes down to here somewhere and then turns around and goes up. Only two possibilities exist roughly, okay, big picture wise. Yeah, so now what are you saying?
So I'm saying that suppose I buy at this market price and I buy suppose 100 shares.
Say you buy 2200 at 2200.
Yes.
Yeah, okay.
And then the capital would come out to be 2200 into 100 shares. So now
Not capital, that's your invested capital.
invested capital. So now I want to risk only 1% of this invested capital.
No, that's not how it works. You have to think in terms of risk capital. Invested capital is not the important part. Okay, this is another important thing that you learn in my courses. This is an idea which does not almost exist in the investment universe, not in theoretical finance. In the professional markets and futures trading, this concept exists. Okay, but other than that, it's a very niche area of the professional money management industry. But by and large, this concept of distinction between invested capital and risk capital does not exist, but it's a very important distinction because your invested capital requirements can change depending on what kind of instrument you're trading. For instance, when you're looking at futures or you're looking at options, okay, your especially for futures, okay, even for margin spot trade, spot FX, okay, you will have very low invested capital requirements. But you still have to be clear about your risk capital allocation. That is the most important thing. Okay, so invested capital is required from a liquidity point of view in certain markets like equities, where you are like you are required to buy 100%. You have to put up essentially beyond the settlement. You have to put up 100% of the equity position as the equity. Okay, in the US markets you can borrow 50% of the value and carry it forward. Okay, so you have different invested capital requirements in different markets depending on what kind of instrument you are trading. But the risk capital thinking, that does not change across any market. Okay, so that is why risk capital is the more important entity, right? Right. So that approach is not correct. So it's clear? Okay. Anything else? I'll close it now.